Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video in which I want to talk about one of the most basic but most fundamental of themes that we should be on top of. This is critical to understanding how we are trading these markets going forward, because it is absolutely the foundation of every investment decision made individually or on aggregate, and that is risk trends. We've had a substantial shake-up in some of the benchmarks for risk this past week, though it was somewhat uneven. We don't have, it seems, the consistency and the momentum to really drive that general fear of risk aversion or that general appetite for yield that we typically see deliver very large and consistent trends. So what are we going to be looking for? Where are we at now? I want to take a quick look at this, and I know a lot of people still have a hard time in assessing how well risk trends are, or whether it be bullish or bearish, though we've covered this a couple of times. So this is more of an update to see where we're at in this general spectrum. Because some people look at this, the S&P 500, and use this as the basic measure of risk trends. And in this basic measure, we've had 3 days of decline, although the Friday close was not very much of a rejection. So we've had a little bit of a pullback, but hardly a wholesale risk aversion move. Same thing from the Dow Jones Industrial Average. But if you look at other measures, perhaps the dollar as a safe haven, right, you would see that its performance is actually quite strong, and that would suggest maybe that there is a safe haven bid. So the Euro USD actually had its worst week since July 2012. So is this a better reading on risk trends, or perhaps is the S&P 500 a better measure on risk trends? I think that the relationship between them, and for that matter, between other benchmarks for risk on, risk off, is where you get your fullest sense of sentiment. Not just in individual measures, but in a broad spectrum of them and in those relationships. So what I did was I made a common chart here, a graph, in which we have a number of very sensitive, risk-sensitive assets. And I made it in such a way that as they showed a greater sense of risk or fear rising, they would move higher in this chart. If it was diminishing, it would drop off. All right, so as you can see here, I have the US dollar as a safe haven. Right, as it rises, risk appetite trends are rising as well. It has shown a relatively modest performance. You have the S&P 500, people's favored measure of risk trends. It's actually off a little bit from the benchmark that I have, but it's not really tumbling off. We have the VIX Volatility Index, one of the more famous measures of fear, but we also have the FX version of that, the FX Volatility Index, and you can see that has actually shot higher. So has the 10-year Treasury yield, which is very risk-sensitive, surprisingly so. And then, of course, we have carry trade, Euro-Yen. Euro-Yen has pulled back as well. Now, I use these and I benchmarked them to a particular point. That particular point was the FOMC rate decision this past week. Why was I looking at that particular event? Because it carries one of the most profound influences on risk trends. Not just because of the event itself and the volatility that it derives from it, but more so because we've seen the influence that stimulus can have. The Fed's balance sheet is without doubt the largest and most influential. We've seen a deviation between the S&P 500 and European and Asian equities. So we look at this as kind of the leading bullish read. If this S&P 500 were to drop back in all of its positive sentiment and all of its confidence of stimulus, then it would be a very strong sign indeed that risk aversion was taking over. Lesser in indexes and measures, in other words, would already be deep into the reversal. So kind of using that as the top level, but at the same time, we're identifying something that has become very important, if not tantamount to absolute confidence. So looking not just at the individual FOMC rate decision, we also have global stimulus. Right? This includes the ECB, the BOE, the People's Bank of China, and the Bank of Japan. And you can see that stimulus continues to build, and that has been very important to reducing risk as we see here in the volatility index. Now, what will we see next week? Are we going to see a full commitment to risk aversion? Something that the U.S. dollar is already suggesting we could be going towards, and dragging with it something like the Aussie USD as well as the Euro USD. Are these moves going to continue, and is it going to spread into pairs like the yen crosses, like the Euro yen, which has a beautiful wedge setup alongside its Swiss yen and pound yen counterparts? If we can get that next level of risk aversion, there are many opportunities that have plenty of opportunity. All right, they have tons of room to move in a deleveraging effort. However, we have to absolutely trigger that underlying sentiment, and that means that the most stubborn or robust, depending on how you want to look at it, measures have to be pulled back. They have to start that cascade effect. So looking at the economic docket for next week, we do have quite a bit of event risk. All right, the docket is actually quite loaded. And we can range from U.S. to European to Asian markets, and they all have something of merit. But I think that a lot of what we're going to get is going to overlook some of the policy officials in the U.S. speaking. The RBA rate decision, that's going to be a kind of commentary on the higher yields. All right, we have Spanish unemployment rate. That is kind of the concern that we have of the troubled countries within the European Union, the kind of slow degradation of the Eurozone in general confidence that we continue to see. We also have the EU economic updates. Those will be notable, but not necessarily our top event risk. Our top event risk comes mostly on Thursday. All right, that's when we have the U.S. GDP for the third quarter. We have the ECB rate decision and the BOE rate decision. Now, these two are going to be quite important. They're going to be important for their individual currencies, and you'll see euro dollar and pound dollar respond to however these events come out. But it's going to have a potentially unexpected side effect on general sentiment itself. Now remember, we're talking about stimulus, but not just from the Fed side, from a global side. The markets are still gauging higher expectations of interest rates for the UK, seeing a hike earlier than what the Bank of England has warned against, and the ECB has started to see some significant deterioration as data, inflation, and in unemployment as a measure of growth. If we do not see these two central banks pull back and offer more dovish interpretations, it could be a very strong sign that another major region of the world is shunning more stimulus. That would have a very detrimental impact on risk adoption. All right. And of course, the third quarter GDP is going to tap into the FOMC considerations. And to that regard, we also have the U.S. October unemployment rate and non-farm payrolls. I watch the unemployment rate because that's more important to the stimulus program there. And we also have Bernanke speaking about the IMF, on an IMF panel about the financial crisis. Now, I'm going to be watching these two particular events because they will give us kind of insight into the Fed chairman and the data that they watch for their policy decisions. And we know there's a December meeting and a January meeting and then a March meeting for the Fed going forward. The debate right now is whether that March meeting is going to be the key taper event or whether it will be moved forward. We'll get a better probability with these particular events. Now, throughout this, you got to remember, we're going to be waiting until Thursday and Friday to get that major event risk. Does that necessarily mean that we won't have a more remarkable risk correction that is fed further by this event risk? Will it just stay there and wait for the event risk? Not necessarily. You can actually get sentiment moving on its own, under its own power, because there's just been enough built-up energy that it eventually just simply unwinds. There's a possibility that that occurs. But if you want to take these medium-term trades on risk, and really that's where most of the medium to long-term trade opportunity exists in this very fundamental of aspects, you're going to need to tap into a market-wide theme, and you will see it play through as a market-wide theme. It won't just be a one-off move in the US dollar. It won't be just a one-off move in the euro. It won't even be a one-off move in broader asset classes like just the FX market. It will be a move that spans all of the assets. So if you're really looking at risk trends, you will see it as a global, market-wide, finance-wide shift. All right, capital will move away from those things it deems risky and move into things that it sees as safe. All right, move away from the overbought, move into the oversold and liquid. That is what we need to watch for next week. Now, this risk theme is very important. We watch it and discuss it on almost a daily basis, but we need to always keep this bigger theme, this bigger picture in perspective. When this big trend starts to develop, we base our trades around it. So if we did see a big unwinding of risk trends, there are many very prominent opportunities out there that have a lot of room to run. But as if we just are sitting on the sidelines waiting for that risk theme to develop, which has been the case for some time, then we have to look for other trades that are going to be defined as shorter term because they don't necessarily match up between the fundamentals and the technicals. All right, so keep that risk picture clear in your head. And when you are certain that there is a big risk trend at hand, then we have the opportunity to place longer term trades. I hope you guys have a great weekend, and we'll do our next Forex strategy video on Monday.